Hey everyone, welcome back to GG Invests. I need to be straight with you about something, because right now the stock market is doing something it has only done a handful of times in history, and most people watching this have no idea what it actually means for their money. According to veteran market strategist Peter Grandich, we may have entered what's called the parabolic melt-up phase. Nobody knows exactly when it ends, but here's the part that should grab your attention. Historically, this phase isn't the time to get in. It's the time to start thinking about getting out. And before you click away thinking this is just another doom and gloom video, it's not. I'm going to walk you through the actual data, the real numbers, and what they mean for you specifically. Because even I looked at some of these charts and thought, okay, that's a little unsettling. Honestly, I'm a bit tired of making these super scripted, over-edited videos where everything has to sound perfect. So today, I just want to talk to you straight. Here's what I found, here's what it means, and you can make up your own mind. So if that sounds useful, hit subscribe. It genuinely helps this channel keep going. And if you disagree with anything I say, drop it in the comments. I read every single one.
Let's lay out exactly what's happening right now. The S&P 500 is up roughly 30% year over year. The Shiller PE ratio, a long-term measure of how expensive stocks are relative to earnings, has hit its second highest level ever, just behind the dot-com bubble of 2000. And when you look at concentration, meaning how much of the market's value sits in just a handful of companies, we're at levels comparable to the 2001 tech bubble and Japan's infamous everything bubble of the late 1980s. Right now, the top 10 stocks alone make up roughly 40% of the entire S&P 500, a level that actually exceeds where things stood at the dot-com peak. On top of that, the Buffett Indicator, which compares total stock market value to the size of the overall economy, is currently sitting about 2.4 standard deviations above its historical average.
For context, that's an extreme outlier reading. So naturally, people are asking, are we on a bubble? Is this the start of a massive melt-up where prices just keep climbing? Or is this all noise while everyone else gets rich around us? Let's actually dig into it. Here's where it gets interesting and a little uncomfortable. A lot of people are drawing comparisons between today's market and 1929, right before the Great Depression. If you overlay the 1920 stock chart with the last 30 years, the shapes line up in a way that's, honestly, a little eerie. Then there's Japan. From 1970 to 1989, the Japanese stock market grew over 22% a year, driven by cheap interest rates that flooded the economy with money. People borrowed against rising land values to invest more, which pushed land values even higher, which let people borrow even more. It was a feedback loop. For almost 2 decades, everyone thought this was the new normal. Until it wasn't. In 1989, the Japanese market dropped 50%. And because of a shrinking workforce, rising government spending, and higher taxes, their economy didn't fully recover for nearly 40 years. Then there's the dot-com crash. Tech stocks fell about 78%. And today, we're sitting at a similar valuation level, CAPE ratio, to back then. So is history about to repeat itself? Let's play devil's advocate and look at the case for a bubble. Here's the argument that we are in a bubble, broken into 3 parts. 1, valuations are stretched. The S&P 500's forward price-to-earnings ratio is currently above 28. The 100-year historical average is around 17. That's roughly 2/3 higher than normal. Either companies need to massively grow their profits, or prices need to come down. 2, demographic pressure, similar to Japan. Birth rates have been falling since the 1950s, while spending on social programs has been rising. Fewer workers are paying into a system that costs more every year. That puts pressure on taxpayers. pressure to raise taxes, and pressure on overall economic growth. To keep things from stalling, interest rates have to stay low and debt has to grow faster than the economy. 3. As outlined by analyst Lance Roberts, several warning signs are flashing at once. Declining personal savings, an aging population drawing more benefits, a heavily indebted economy, high youth unemployment, and an economy relying on productivity gains just to offset job losses.
The argument here is simple. The economy is being artificially propped up, valuations don't match the fundamentals, and eventually things revert to the mean, which would mean a market correction. That's the bear case. Now, let's look at the other side. Now, here's why prices might keep climbing. But stick around, because the next part is honestly the most important section of this entire video. If you're new here, this is exactly the kind of breakdown I do every week. No hype, no buy this coin now, just data and context so you can make your own decisions. If that's useful to you, take 2 seconds and hit subscribe. It really does help this channel grow. Okay, let's get into it. Now, here's why prices might keep climbing. First, yes, stocks are expensive by historical standards, but these companies are making far more money than companies did during the dot-com era. And as smaller companies catch up, that should actually reduce volatility over time, not increase it. Second, markets don't usually fall just because prices are high. Usually there's a specific shock that triggers a sell-off. Right now, we're still relatively early in this bull cycle compared to past crashes. Third, earnings today are genuinely strong. The so-called Magnificent Seven, Alphabet, Amazon, Apple, Meta, Microsoft, Nvidia, and Tesla are performing exceptionally well. According to Fidelity, cash flows exceed income, profits are above their 5-year average, and forward earnings are still below the 2001 peak. In fact, the average price to earnings peak in 2001 was 65. Today, it's 28, less than half.
And here's a question worth asking. What's the alternative? Over the last 50 years, holding cash returned an average of just 0.9% annually. Over the last 20 years, cash actually lost 1.8% a year in value after inflation. So your choice is essentially a guaranteed loss in cash or a possible short-term loss in stocks with effectively unlimited long-term upside. Now, even with that bullish case, Fidelity outlines 5 specific warning signs everyone should keep an eye on. Companies burning through cash faster than they're earning it. Businesses owning large stakes in each other, creating a domino effect if one falls. Debt growing faster than profits. AI growth hitting an energy ceiling that caps further expansion. Rising borrowing costs squeezing profit margins. On the flip side, some analysts argue we shouldn't compare today's valuations to the last 150 years because the economy fundamentally changed once the internet became widely adopted. Financial writer Ben Carlson makes this point well. If you look only at the last 30 years instead of the full historical record, current valuations look far less extreme, closer to the average for this more modern era. Margins are improving, and the argument is that companies are simply growing into these high valuations, rather than being dramatically overpriced. There's also a popular theory that the market isn't really going up. The dollar is just going down due to money printing. But when you look at the data, the dollar actually depreciated through the 2000s and appreciated through the 2010s, while the market moved up and down independently of that. Research from Fisher Investments found the correlation between the dollar's value and S&P 500 returns is close to 0, about 0.15. Global stocks were up 76% of the time, regardless of whether the dollar was rising or falling. So, bubble or not? Here's the honest answer. For history to repeat exactly like Japan, Earnings would need to completely stall, and the S&P 500 would need to roughly double from here. That's not impossible, but it's a big if. What is true is this. Valuations are elevated. Risk is higher than it's been since 2021, and the smart move right now isn't to panic, it's to prepare. That means having a stable income, staying properly diversified, making sure you could financially handle a 30–50% correction without being forced to sell. Here's the thing about trying to predict tops and bottoms. Even geniuses get it wrong. Isaac Newton invested early in the South Sea bubble of 1720, made a profit, got out, and then watched the price keep climbing. Convinced he'd been wrong to sell, he bought back in near the very top. The bubble collapsed shortly after, and he lost almost everything. The lesson? The market can stay irrational a lot longer than you can stay confident in your predictions.
My approach, and what I'd suggest considering, is staying diversified across U.S. and international markets, keeping a portion in safer assets like treasuries as a buffer, and continuing to invest consistently regardless of what the headlines say. Is that boring advice? Sure. But the people who've stuck with that approach over the long run have consistently outperformed those trying to time the market perfectly. If this video helped you understand what's actually going on right now, hit subscribe. I break down market news like this regularly. No hype, just the data. And let me know in the comments, do you think we're in a bubble, or is this rally just getting started? Thanks so much for watching, and I'll see you in the next one.